Hi, Professor Barati. I want to discuss with you uh, common stock valuation, as I think what you'll get out of this isn't so much common stock valuation, but I think what you'll get is really the time value of money. What I appreciate about this practice isn't so much valuing the price of a stock, and in reality, there's no science behind pricing stock. If there were, everyone would be billionaires, and if it were, stocks would only go up. So as we know, stocks go up and down every day, every minute. And so nobody gets it really right. It's just a matter over the long term. Companies do get it right, and you have to find those companies or pay a portfolio manager through a mutual fund to find those companies for us and help us grow our money. But that said, what I want you to think about this is more of the math and logic behind it, because this type of analysis can be used when buying an apartment building or buying a small business or a franchise for yourself, if you want to buy a little franchise and go into business. Because in the end, the value of anything is measured by the cash flow it gives off over an extended period of time. And the art, the science is basically the present value table. It's given to you. That's the math. But the art is figuring out what rate to use as a discount rate. And so therein lies the art form of this, and that's why stocks basically go up and down every day, and people change their minds about all these metrics. So the valuation of a common stock is really the present value expected stream of future dividends. Now, if a company doesn't pay dividends, and some of the best companies, best performing stock companies such as Amazon, Netflix, Facebook do not pay dividends, yet you would have done very well investing in those companies. So the argument here is those companies are growing very fast, and they need that cash flow to reinvest their growth rather than give it to us, the shareholder. And we're willing to basically delay that dividend for the price appreciation, because we're willing to trade some of the safety and security of dividends for price appreciation and capital gains, knowing that eventually that company is going to mature. And when it does mature, it's going to build itself into a cash flow machine. The perfect example is Microsoft. Microsoft in its early days was just as exciting as Amazon, had just as much growth and capital gain appreciation as Netflix. And we're going to use Microsoft in this example. But now Microsoft is not only gives you a nice price appreciation on capital, but they are a great dividend machine. They give off a lot of dividends to their shareholders, and they grow their dividends every year, which is probably more important than the actual dividend per share. Is more important is the growth rate, because as you'll see in this formula, growth rate very much drives the price of a stock or any cash producing investment. So that's basically a valuation of a common stock. And here's the dividend valuation model. Similar to a bond valuation, except we don't have to worry too much. We're not guaranteed that $1,000 principal back. That's pretty much what separates the two. We don't know what the price is, and we don't know when we're going to sell this stock and at what price we're going to sell it for. Unlike a bond, we know that if we hold a bond to maturity, we will get back the principal, assuming the company or the government doesn't default. That's why bonds are less risky and more predictable. But they do share very much the same metrics. For example, the yield to maturity on a bond is essentially the discount rate. Here, the discount rate is going to be the required rate of return, which again, we're going to have to basically plug in to our formula. But the dividend valuation model basically takes the dividend that we are going to get each year and divide it by 1 plus the required rate of return and the discount rate to get the price of a bond. The price of a stock. This is very simplistic, so I'm not going to spend a lot of time on this slide. It's very simplistic, and basically stocks are grouped into 3 categories: no growth in dividends, constant growth in dividends, variable growth in dividends. We're going to use mostly constant growth in dividends because there's history that can give us what the growth rate is going to be based on historical measures. Variable growth in dividends is probably the more realistic predictor. But as you know, present value gets kind of crazy when you have to use different discount rates for different periods. So essentially, a no growth with dividends is the dividend at the end of the year divided by the required rate of return for the common stock equals the price. This, you'll recall if you read the chapter, is the same valuation as a preferred stock. It assumes that the dividend is fixed, doesn't change. The only thing that will change the price is your required rate of return. Constant growth in dividends assumes the dividend plus the dividend rate of growth in that dividend for each year. So if your dividend is $1 and the growth is 5%, okay, that dividend in this year will be $1.05. If the dividend is $1.05 and the growth rate is 1.05 again, basically to the second power, you're going to get a higher dividend rate. Essentially, this is just compounding the numerator. It's a compounding equation. G is the constant growth rate in dividends, and K is the required rate of return in common stock. So very simple formula. First year, dividends $1.87. It's growing at a 7% rate, $2, $2.14, $2.29, plus an infinite dividend divided by the required rate of return to the power, which gives you the present value. So the firm has a constant dividend growth rate. The discount rate must exceed the growth rate to determine the price. So the discount rate, K, minus the growth rate has to be higher, or else you'll have a negative denominator. The price today is basically $2, which is the first year of the dividend, divided by the required rate of return of 12% minus the growth rate of that dividend, divided by 0.05, is estimating that this stock is worth $40. The problem lies when we have stock valuation based on future stock value. In reality, most stock values are not based on next year's dividend and 1 year's of required rate of return. We buy stock usually to hold for extended periods of time. So in that sense, the present value using a discount rate of the future dividends becomes part of our equation. So assume the stock is held for 3 years and then sold. Adding present value of 3 years of dividends and the present value of a stock price after 3 years gives us the present value of benefits. The appropriate formula is P sub 3, which is the price of the stock after year 3, divided by the present value of the 3 years of dividends, which they call D sub 4, divided by the required rate of return minus the growth in that dividend. To get the required rate of return, simply take the dividend of sub 1, year 1, divided by the price of a stock. Now, just so you know, the dividend divided by the price of a stock is the yield. It's the yield of the stock, the dividend yield. And you can get that just simply by looking up a stock symbol and getting the dividend yield. You don't even have to do this calculation. Take the dividend yield and add it to your growth rate of that dividend to get the required rate of return. The stockholder receives current dividend plus anticipated growth in future. If the dividend yield is low, the growth rate must be high to provide a good return. If the growth rate is low, a high dividend yield will be expected. Example, if a dividend yield is low, that's typically found in a high growth technology company. Therefore, we expect a bigger growth rate to drive that price. If you buy utilities, they tend to be very slow growing companies. Utilities are fairly boring and don't grow very fast, but they tend to have higher dividends. So you focus more on the yield. I'm going to put this down for a second and show you, put this in practice in the real world. Here's a website that I will send to you via our discussion class. And it is actually basically a great way to learn about stock valuation, probably better than it's a text. So I'll read this quickly. How much is a share of stock really worth? Logically, based on facts, the answer is simple. A company is worth the total amount of cash it will generate over its lifetime, discounted to its present value. You do not need to have a background to read this article. So basically that's what 15 pages of text tries to teach us. So here's where the art comes in. One is, what is the discount rate to use? Okay, there's no there's no right answer here. It's basically educated guess. And what is the cash that it will generate over its lifetime? Do we really know what kind of company Netflix or Microsoft will be 20 years from now? We don't. But we're going to hope and bet our money that history will be an indicator. So here's a little theory on the discounting cash flow. Company is valuable to stockholders for the same reason a bond is valuable. Both are expected to generate cash for years. Company profits are more volatile than bond coupons, but as an investor, your task is the same. In both cases, make a reasonable prediction about future earnings, then discount them by calculating how much they're worth in today's dollars. Let's take an example. Suppose you are interested in a company that earned $10 per share over the last 12 months, assuming you expect the company to grow over the foreseeable future so that its earnings will grow at a rate of 8%. Then to play it safe, you make no assumptions about earnings after that. So essentially, you're using a discount cash flow formula to do that. Let's get to this dividend discount because that's what our chapter emphasizes. The dividend discount model is more conservative variation of discount cash flows that says a share of stock is worth the present value of its future dividends. In this model, we prefer dividends as the cash numerator instead of earnings per share. This is because it's more conservative. The reason why it's more conservative is we don't really know what the earnings per share is going to be for a company 5, 6, 7 years from now. But great companies do indeed maintain and grow their dividends every year, in fear that if they don't or cut the dividend, the stock price will go down, and drastically at times. So great companies like J&J and Microsoft do give us dividends. It's something that is tangible. We get it. It's given to us in the mail, or it's transferred to us through ACH, and we know it grows every year. John Burr Williams wrote his book in the 30s about the importance of using dividends instead of earnings as the cash flow to discount. A stock is worth the present value of all the dividends ever to be paid upon it. No more, no less. Present earnings outlook, financial condition, capitalization should bear upon the price of a stock only as they assist buyers in estimating the future dividends. So let's go to this calculator. In this calculator, instead of using earnings, use dividends. So let's go to Guru Value, and let's go to Microsoft and see what that dividend is. Microsoft dividend is currently let's see what it is. Cash dividend is 42 cents a share at 4 quarters. It's paid quarterly. So we're going to say that they're paying $1.68. So we're going to put $1.68. Expected dividends, instead of earnings, we'll replace earnings with dividends, are expected to grow at a rate of, according to Microsoft data, their growth rate on dividends has been an amazing 15% over 5 years. Before leveling off to a growth rate of, we don't know, but I don't think they're going to basically be able to maintain a 15% annual growth rate. Let's say it levels off to a comfortable 5%, and that could be 40, 50 years from now. The rate of return available on a benchmark. Let's say our required rate of return is 11%. Well, in this case, let's say it's 11% minus our growth rate, but that's 15, so we can't use it. It would be negative. Let's say we use 11% as our required growth rate. According to this, the stock value of Microsoft is $44.45. Now we know that the price of Microsoft is much higher at $93. So obviously it's priced high. Investors are willing to pay that much more for Microsoft right now. Or we could basically say the return on our benchmark is lower than 11%. Companies might be saying Microsoft is a better investment than the entire stock market, and our growth rate, required rate of return, might be more like 7%. As you can see, this is why stocks are volatile. We basically can force the unknowns to get any price we want. The dividend discount model is more conservative, as we stated. Basically, Warren Buffett uses this, and he uses a slightly different scenario. So if we take the dividend of $1.68, dividends are expected to grow at 15% for the next 5 years, before leveling off to, let's say, 7%. How confident are you that these expected future earnings will really materialize? I'm going to say, in this case, I'm 90% confident. Again, this is where the art comes in. Best available return that you have, 100% confidence, like a treasury bond. Right now, the 10-year treasury is at 2.89. The long-term growth rate needs to be less than the discount rate. So the 2.89% is what Buffett uses as his discount rate. That is very low. So we're going to lower this to 2%. We're going to say after 5 years, Microsoft is going to grow its dividend at 2%. Personally, I don't think that's realistic. I think it's going to be higher than 2%. So I'm going to say that Microsoft is going to grow their dividend 15% for at least another 10 years. Under Buffett, Microsoft was worth a lot more money. But if we don't want to use a low 2.89, we could say my required rate of return is essentially 10%, which is the market. But then I'm going to say that Microsoft is going to level off at a growth rate of 5%. What a drastic change, 68 versus 500. So the discount rate is really basically hits the price of the stock pretty hard. I want to read you finally one last article right here, perfect for our discussion. Buffett on discount rates and what Buffett uses. Once you've estimated future cash inflows and outflows, which you can start with dividends, what interest rate do you use to discount that number back to arrive at the present value? According to Buffett, his feeling is that the long-term government rate is probably the most appropriate figure. And when Charlie and I felt subjectively that interest rates were on the low side, we'd probably be less inclined to be willing to sign up for that long-term government rate. But the logic would drive you to use a long-term government rate. If you do that, there's no difference in economic reality between a stock and a bond. In this sense, it makes sense. You're basically neutralizing your decision to buy a stock or a bond by using the same discount rate. The difference is that the bond may tell you what the future cash flows are going to be in the future, whereas with the stock you have to estimate. That's a harder job, but it's potentially a more rewarding one. Logically, if you leave out psychic income, that should be the way you evaluate a farm, an apartment house, or whatever. And in general way, that's how Charlie and Warren Buffett do it. Charlie is Warren Buffett's partner. So that's the reason why I wanted to go through this exercise. It's not for you to say, oh, I can all of a sudden decide how much stocks are worth and become a great investment guru. What I want you to get out of this is to really understand how to use the importance of estimating cash flows, what cash flows to use, coming up with a logical discount rate, and basically analyzing anything you decide to invest your hard-earned dollars in, even if it's a two-family home that you want to rent. You can use a two-family home, gives off cash flow. You know you're going to raise rents every year. That net cash flow after expenses can grow 1 or 3% by rent increases. You plan on owning that apartment building 5 years, you can discount that by a rate, essentially use the mortgage rate. You have to basically exceed the interest you're paying to buy that home. The mortgage rate could be your discount rate. So with that, I thank you for watching, and feel free to use this in the discussion. Thanks.